Welcome to BizPoints. Today we're analyzing Alphabet's Q2 2024 performance and its future trajectory in light of a recent antitrust ruling. Let's delve into the details. Part 1. Alphabet's Q2 2024 financial analysis. Let's begin with a comprehensive examination of Alphabet's key financial metrics for the second quarter of 2024. Total revenue reached $84.7 billion, representing a 14% year-over-year growth. This substantial increase demonstrates Alphabet's continued market expansion and revenue generation capabilities. Operating income surged to $27.4 billion, marking a significant 26% increase. This notable rise in operating income suggests enhanced operational efficiency and cost management within Alphabet's business model. Net income grew to $23.6 billion, up 29%. This robust growth in net income indicates strong profitability and effective management of expenses relative to revenue. Earnings per share reached $1.89, a 31% increase. This metric is particularly salient for shareholders as it represents the portion of the company's profit allocated to each outstanding share of common stock. The operating margin improved from 29% to 32%, indicating enhanced efficiency. This metric suggests that Alphabet is generating more profit from each dollar of revenue, a positive sign of operational optimization. These figures collectively illustrate Alphabet's continued growth trajectory and improved profitability. Now, let's dissect the performance of Alphabet's primary business segments. 1. Google Services. This segment, encompassing Google Search, YouTube ads, and the Google Play Store, remains Alphabet's primary revenue generator. Total revenue, $73.9 billion, up 12%. Google Search and other services, $48.5 billion, up 14%. YouTube ads, $8.7 billion, up 13%. Google Network, $7.4 billion, down 5%. 2. Google Cloud. This rapidly expanding segment, providing cloud computing services to enterprises, demonstrated substantial growth. Revenue, $10.3 billion, up 29%. Operating income, $1.2 billion, a marked improvement from $395 million in the previous year. 3. Other bets. This segment, comprising experimental projects with potential future revenue streams, showed mixed results. Revenue, $365 million, up 28%. Operating loss, $1.1 billion, widening from the $813 million loss in the prior year. Part 2. Analysis of the antitrust injunction and its implications. Now let's examine the recent antitrust injunction against Google and its potential ramifications for Alphabet's future. This legal decision, set to take effect on November 1, 2024, aims to foster competition in the Android app ecosystem. Here are the key provisions and their potential consequences. 1. Revenue sharing restrictions. For a 3-year period, Google is prohibited from sharing Google Play Store revenue with entities that distribute Android apps or intend to launch an Android app distribution platform. Potential implications. This could diminish Google's ability to incentivize partners to exclusively utilize or promote the Play Store. It may create opportunities for competing app stores to gain market share. Google might need to explore alternative strategies to maintain its app store's dominance, possibly through enhanced user experience or developer tools. 2. App launch and exclusivity modifications. Google is barred from conditioning payments or access to its products on agreements for app developers to launch apps first or exclusively on the Google Play Store. Additionally, it cannot prevent developers from launching different versions of their apps on third-party Android platforms. Potential implications. This could lead to a more diverse app ecosystem across different Android app stores. Developers may gain increased flexibility to experiment with features and versions on various platforms. Google might need to compete more on the merits of its platform rather than through exclusivity agreements. 3. Revised regulations for OEM and carrier agreements. Google is prohibited from entering into agreements with original equipment manufacturers, OEMs, or carriers to pre-install the Google Play Store in specific device locations or prevent the pre-installation of competing app stores. Potential implications. This could result in a more diverse ecosystem of pre-installed app stores on Android devices. Google may need to focus more on user acquisition and retention strategies for the Play Store. Competing app stores might gain increased visibility and user adoption. 4. In-app payment liberalization. Google cannot mandate the use of Google Play billing or prohibit alternative in-app payment methods. Developers must be allowed to communicate with users about other payment options. Potential implications. This could significantly impact Google's revenue from App Store fees. It may lead to the proliferation of alternative payment systems within apps. Google might need to innovate to make its payment system more attractive for voluntary adoption. 5. Third-party access to Play Store catalog. Google must allow third-party Android app stores to access the Google Play Store's app catalog, with developers retaining the option to opt out. Potential implications. This could enhance the appeal of competing app stores by providing access to a wider range of apps. It might diminish the unique value proposition of the Play Store. Google may need to focus on other differentiating factors, such as user experience or security features. Part 3. Alphabet's strategic outlook. Given these regulatory changes, how might Alphabet adapt its strategy? Here are some potential areas of focus. 1. Intensifying investment in AI and cloud services. Sundar Pichai, Alphabet CEO, emphasized the company's AI initiatives. All 6 of our products with more than 2 billion monthly users now use Gemini. End quote. This statement underscores the pervasive integration of AI across Alphabet's major products and services. The company is also substantially investing in cloud infrastructure. Ruth Porat, CFO, stated, "We continue to expect quarterly CapEx throughout the year to be roughly at or above the Q1 CapEx of $12 billion." End quote. This significant capital expenditure underscores Alphabet's commitment to developing and maintaining world-class AI and cloud infrastructure. As the App Store ecosystem becomes more competitive, these investments in AI and cloud services could become increasingly critical. By offering superior AI capabilities and cloud infrastructure, Google could maintain its attractiveness to both developers and users. 2. Enhancing user experience and security. With the Play Store potentially losing some of its inherent advantages, Google may intensify its focus on improving the user experience and security features of its App Store. This could include more sophisticated app discovery mechanisms, enhanced security protocols, and refined user interfaces. 3. Diversifying revenue streams. The potential reduction in App Store revenue might accelerate Alphabet's efforts to diversify its income sources. This could involve expanding e-commerce initiatives. Philip Schindler, Chief Business Officer, mentioned, "We're beta testing virtual try-on and shopping ads and plan to roll it out widely later this year." End quote. This initiative could enhance the online shopping experience and potentially increase ad effectiveness. Enhancing YouTube monetization. Schindler also noted, "We're also seeing a very encouraging contribution from brand advertising on Shorts, which we launched on the product in Q4 last year." End quote. This suggests that Google is successfully monetizing short-form video content, competing effectively with platforms like TikTok. Increasing focus on hardware, the company might place greater emphasis on its Pixel line of devices and other hardware products to create additional revenue streams. 4. Accelerating global expansion. Alphabet might accelerate its international expansion efforts to tap into emerging markets. Pichai noted, "In Q2, we announced our first data center and cloud region in Malaysia and expansion projects in Iowa, Virginia, and Ohio." End quote. This global expansion strategy aims to improve service delivery and capture new market opportunities. 5. Navigating privacy and regulatory complexities. The company will need to continue balancing privacy concerns with its business model. Pichai announced a shift in approach to privacy on Chrome. On third-party cookies, given the implications across the ecosystems and considerations and feedback across so many stakeholders, we now believe user choice is the best path forward there. End quote. This change in strategy demonstrates Alphabet's efforts to balance user privacy with the needs of advertisers and other stakeholders in the digital ecosystem. 6. Sustaining long-term investments. Despite the challenges, Alphabet appears committed to long-term investments in future technologies. For example, they announced a $5 billion investment in Waymo, their autonomous driving technology company, indicating a continued focus on potential future growth areas. The antitrust injunction presents significant challenges to Alphabet's dominant position in the Android app ecosystem. However, the company's strong financial performance, diverse business segments, and ongoing investments in AI, cloud services, and emerging technologies suggest it's well-positioned to adapt to these new market conditions. Key questions for the future include: 1. How will the changes in the App Store ecosystem affect Alphabet's revenue and market position? 2. Can Google Cloud and AI initiatives offset potential losses from the Play Store? 3. Will Alphabet's diversification efforts, including hardware and other bets, yield long-term returns? 4. How will the company navigate the increasingly complex global regulatory landscape? In the rapidly evolving tech industry, adaptability will be crucial. Alphabet's future success will depend on its capacity to innovate, diversify, and respond effectively to these new market dynamics. If you found this clip useful, we would appreciate it if you could help by liking, sharing, and subscribing, as well as viewing our other clips on other companies. Thank you.